In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, tech names plunge. In a single day, HP Inc. dropped 17%, Box falls 19%, Fitbit sinks 14%, all on the back of earnings. What does it mean for the rest of tech? Plus, could Uber make a big global play ahead of its planned IPO? The ride-hailing giant is in talks to buy a big Middle East competitor in a multi-billion-dollar deal. And after dropping a few cryptic hints on Twitter earlier this week, we have coverage of Elon Musk's Tesla news. And we begin with the breaking news. Tesla mystery solved. Elon Musk is launching a new Model 3 at a lower base price of $35,000. The news first broke in the electric car blog Electrek. This after Tesla CEO Elon Musk teased some mysterious Tesla news earlier this week, tweeting Thursday, 2 p.m., California. Some Tesla news. Well, now we know, presumably, what it's all about. Tesla is holding an event at this very hour where we presume they're going to be announcing this officially. Tesla shares have been halted after hours, and Tesla has halted new car orders on its website. To discuss, we've got Loop Ventures managing partner Gene Munster on the phone in Minneapolis and in Detroit, Bloomberg automotive reporter Keith Naughton. So, Keith, what do we know so far?
Well, going with a lower price Model 3 with a shorter range gives Elon the opportunity to meet these very ambitious sales volume targets he has. You know, they're planning to produce 400,000 Model 3s this year. That's a lot of Model 3s, and you can't sell them all at over $50,000. So having a lower priced Model 3 should bring in new customers, bring in value customers. The average price of a car in the United States these days is $37,000. So this makes it a Joe average kind of Tesla for the first time.
Gene, hasn't Tesla promised that the price would eventually come down to $35,000? It just took some time to get there?
Yeah, this was the original promise back 2 years ago, Emily. And so in some respects, this isn't news, but in other respects, it's probably the biggest news since the Model 3 itself was announced, because the simple math was that many people felt that this car, to get to $35,000 and to produce it profitably, was impossible. And so I think that is what is so important here. The $35,000, it doesn't sound like it's that significant, but compare that to the rest of the car industry, which the few that do have EVs are typically at 70,000 plus right now. And you can start to quickly see why Tesla's 80% market share that they had in the U.S. last year on electric vehicles, they can maintain that kind of share, at least in the near term, the next 1 or 2 years.
Right. Tesla, as you mentioned, already way ahead in the electric car market. It's going to be hard for other automakers to catch up. Again, Tesla shares halted as we wait for Tesla to officially announce what we believe will be a lower cost, $35,000 base price for the Model 3. Keith, why did it take these 2 years to get here?
You know, it's typical of automakers, and I know Tesla is not a typical automaker, but usually you start with the higher price models because that gives you the biggest profits. It gives you the payback. And then you move down the price ladder and start putting out the lower price models and go for the volume. So you need to get a critical mass going with those high price ones. He's achieved that, but now he has these very ambitious production targets. And in order to sell all those cars he plans to produce, he really needs to have a lower price model.
Now, Gene, how many more cars do you think Tesla will be able to sell at this price? How does this change your model?
Well, it will. Right now, we were a little bit conservative relative to their 400,000 expectations. We're at 300, so we probably need to go and rethink what our estimate will be for this year and for next year. But the simple takeaway is this, is if you look at the broader market, there's 80 million vehicles sold a year. Last year, globally, is 1% of those were electric. In the future, there's no question that 100% of vehicles, now that might be 2 years from 10 years from now or 30 years from now, but that's ultimately where we're going. And so I think how many can they sell? What does it mean for the model? Is this can be a significantly bigger company because of the $35,000 price.
Meantime, Keith, earlier this week we covered the news that the SEC has asked a judge to hold Musk in contempt for his tweets around those production numbers, with which Gene was mentioning. Is it 500,000 or 400,000? And did he tweet too soon? Do you think some of these legal issues could impede Tesla's progress this year?
Well, they could impede Elon's progress, that's for sure. You know, he once again, as we know, put out a tweet that said they were at a 500,000 rate on the Model 3 when, in fact, they're going to produce 400,000 this year, and he had to correct that. So he continues to tweet unfettered, and that's the issue the SEC has.
Gene, you had some choice words about Musk's latest tweets. You said that he has been reckless. How concerned are you that these issues will continue to affect his leadership and possibly then the company?
Concerned, and I want to make it clear that I'm a believer in the Tesla story and believe in Elon Musk and think that he is still better that he is part of the company. But nonetheless, I was at one point 6-9 months ago hopeful that he could change. And unfortunately, he's not going to change. He's going to continue to do some reckless things on the edges. And I just hope that this recklessness doesn't actually impact the business, because the company does have a wonderful mission, and I think they're in a great place to change the world.
Now, we're continuing to get headlines now out of this official Tesla news conference. Tesla saying it's shifting worldwide sales to online only. It says the Model 3 will have a 220-mile range, top speeds, 130 miles per hour. Gene, what does that mean?
It means that it's a great car. And I think that other electric cars that are even kind of in this $40,000, $45,000 range, they're not cars that you would want. And I think that's the big takeaway here. This is an electric car that you'd actually want. And we're not even talking about some of the tech inside. That's just some of the specs around the performance of the car. So I think when you compare at this price point, it will be 80% plus market share and probably close to 100% market share. It's just, and I think that the car companies, the industry, is going to go through an incredible turbulence in the next few years, because to try to build something comparable that they can do at scale and make money on is a calculus problem that I don't think they're capable of solving.
Keith, Tesla doesn't do much traditionally, as you've said. Is there any other automaker that has online-only sales?
No, the automakers use the traditional dealer network. Elon has been, you know, very explicit in how he wants to sell direct to consumers, which has gotten him in, you know, sort of trouble with state regulators who are very tight with traditional dealers. So he's finding a model that works for Tesla. And an important thing about this car, you know, it won't have quite the range of the more expensive models, but it will bring in new customers to Tesla that will be the seed corn for this brand. This will give them a future beyond just the very wealthy people who've been able to afford Teslas before this.
I still remember being at Tesla the day the Model 3 was unveiled, taking a test drive in one of those early models, Gene. What does this cost? Let's talk about what the cost means in terms of Tesla making money. They can get the car down to this price, but how will that impact Tesla's bottom line?
What they've said versus what it's going to look like initially are two different things. And I think the answer is that these initial units will likely not be profitable. I can't imagine them making money on them for the next several months. But they do have ambitions. And they talked about in the December quarter that gross margins should be 20%-ish on the Model 3. And so now that was with an average selling price of just over $50,000. So as you kind of scale that back to 35, I think that the math is there. And I mentioned that earlier. I think that that's the real substance here, is that they're able to produce a car at, I think the average price is going to end up being close to $40,000 at the end of the day, but still at a much lower price and be profitable. And as long as they can keep it to really 5% or better margins on that, I think investors would be thrilled, because of this size of this growth curve is one of the biggest waves coming in tech.
Now, getting more detail from this Tesla news conference, not only are sales shifting to online only, but Tesla says that all the sales going online, combined with other ongoing cost efficiencies, will enable them to lower the cost of all cars by about 6% on average, allowing them to get to that $35,000 Model 3 price point. Keith, what does this all add up to?
Well, I think what it means is Tesla sees some competition coming from the German luxury car makers. Others are trying to replicate the Tesla formula, and they're trying to get out ahead of that. They are trying to build a critical mass so they can continue to control the lion's share of the pure electric market.
All right, Keith Naughton for Bloomberg News out of Detroit. Gene Munster of Loop Ventures, thank you both. We're going to continue to follow what comes out of this Tesla news conference and bring you updates as we have them. Meantime, terminal users can follow along with all the latest analysis. Just check out our T-Live blog. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. A handful of tech names got dragged through the red Thursday after reporting disappointing earnings results. Box, Fitbit, HP Inc. saw some of the biggest swings. The poor results come on the tail end of a fourth-quarter earnings season that has helped fuel a 23% rally since the market rout bottomed out on Christmas Eve. I want to get to New York, where we're joined by Daniel Flax, Neuberger Berman, senior research analyst, and Shira Ovide with Bloomberg Opinion. So, Daniel, all of these are different companies, but certainly tech is a common theme. What do they have in common aside from tech?
Well, Emily, I think if you look at some of the companies that disappointed today, there's some very specific stories, like, for example, with Hewlett-Packard, where people are worried about the printing supplies growth, and printing supplies contributes an outsized percentage of the profit. If we look at Booking or Box or Fitbit, ultimately those are concerns around competition and the need to invest to help differentiate. But if we step back and think about what's going on in technology, a lot of the key secular trends remain healthy. The move to the cloud, really the digitization, if you will, of society. So we see a lot of opportunities even with some of the macro headwinds. So, for example, we would highlight Cisco, which is a leader in networking that's really transformed its mix towards more software and services. And we think margins and earnings will be better than the market expects. Another name we like is Motorola Solutions, which is a leader in public safety, and they're pivoting to faster growth areas like video. They have an excellent management team that's been able to execute on transitioning the company to newer areas and expand margins. Another name we like is Alphabet. We think the core search business is healthy, YouTube has very strong growth, and newer areas like the Google Cloud Platform are somewhat underappreciated. And then longer term, they have opportunities in areas like autonomous driving with Waymo. And the other one we would highlight is Apple, where we think the strength of the ecosystem is underappreciated. While sure there are concerns about the iPhone and China, the install base is growing, user satisfaction is high, and they're doing a good job in newer areas like services and wearables. And the wearables, I would say, helps demonstrate that innovation is still alive and well. So we expect the environment to remain choppy. The macro obviously is going to be a focus for some time, and none of these companies have great visibility. But those that are able to innovate and differentiate with products and services, we think can create additional shareholder value over the next 1 to 2 years.
So, Shira, some names we talk about there on the show all the time, Apple, Alphabet, but some other names that we don't hear very often, along with, HP Inc., Box, Fitbit, as we're discussing today. How does what's happening with them fit into what's happening with big tech?
Yeah, I mean, Dan's point, I think, was right about there's this general secular shift towards cloud technology, but what that's meant is that there are a handful of high-growth cloud software companies, names like Workday and Viva Systems and Salesforce and Atlassian, and they've had really impressive stock price run-ups, even accounting for the dip in stock market prices around September, October last year. And what that's meant is that now those stocks are looking pretty expensive relative to themselves and relative to the overall stock market. And, the piece I wrote today was basically saying, look, the growth rates are coming down for those high growth software companies, and the multiples of revenue, their valuations, are going up. And so that sets them up for a crater if and when there's any kind of hiccups in performance or the macro environment.
Dan, I'm curious for your outlook on some of the big tech names that you didn't mention. Of course, you talked about Apple, you talked about Alphabet, but what about the others? Of course, we know Facebook has struggled. Netflix is certainly in a unique position.
Sure, Emily. So we like Facebook, and while we think there's a lot of work that they need to do around data, security, privacy, I think the company, the management team is appreciating the severity of the situation, and we're seeing a greater willingness to change and try and improve the health of the platform. What's interesting there is, despite all of that, the metrics of the underlying business remain healthy. And if we look at some of the other platforms underneath the Facebook umbrella, you've got Instagram, which is showing very strong growth. You have newer properties like WhatsApp and Messenger that we think could be increasingly monetized over time. So with the core Facebook, you do have this transition to stories, and it will take time. But the results to date and the outlook suggest that there is quite attractive growth. Shifting to Netflix, what we think is interesting here is that the company is continued to push ahead with differentiated and unique content, and they've coupled that with a direct relationship with their users. And so they're helping to really redefine the television experience. And so all of these companies, there is execution risk, sure, there's competition, but we think they're very interesting. Another name we would point out that we continue to like is Amazon. And the reason Amazon remains interesting in our view is they're executing well in their core e-commerce business, but they're doing a terrific job with the Amazon Web Services. And when we speak to customers, to buyers, this shift to the cloud is really very much in its infancy, and we think that they're going to have attractive growth for several years to come there. And the last piece we would emphasize with Amazon is that they have an advertising business which is smaller, it's growing quickly, it's accretive to margins, and we think that's somewhat underappreciated. And so pulling this all together, the key trends around cloud, mobile, social, they're not without complications, certainly in terms of the social elements and data and privacy, and we do think more regulation is necessary. But if these companies can invest appropriately and continue to innovate, then we think there's additional value to be created.
And more regulation could be coming, especially with the FTC forming a new task force to look at past acquisitions even. Speaking of the cloud, Shira, you got a piece out today titled "Forget FANG, Stock Bubble Could Be in the Cloud." Explain.
Yeah, and it's really, again, about looking at how expensive those cloud stacks have gotten relative to their expected revenue over the next year. I came up with the, I apologize for this acronym, I came up with the fake acronym PUTINs for those to describe those stocks, because every grouping of stocks needs its own acronym these days. And, you know, I looked at basically the median multiple, right? So how much are investors paying for each dollar of future revenue? And all 17 of this kind of grouping of cloud companies I looked at, they're all trading above their 2-year multiple average. And again, that implies that the expectations are now very high for those cloud software companies like Atlassian and Workday and Salesforce and so on to deliver on the growth promises. And if they don't, we might see the kind of stock craterings that we see periodically from these high growth, high expectation kind of cloud companies.
All right, so much to discuss and follow, especially as Coatue Management just released this idea of the new FANGs. So all of this will definitely continue to follow. Daniel Flax with Neuberger Berman and Bloomberg's Shira Ovide. Thank you both. Coming up, Uber is looking to expand its operations ahead of this year's IPO, how the company is growing in the Middle East next. This is Bloomberg. Uber is expanding its operations in the Middle East. The ride-hailing giant reportedly in advanced talks to buy its Dubai-based rival Careem, one of the most valuable startups in the Middle East. While no final agreements have been reached, the companies could announce a deal in the coming weeks that would value Careem at about $3 billion. This as Uber aggressively pushes growth as it prepares for its upcoming IPO. Joining us from New York to discuss, who else but Bloomberg Tech's Eric Newcomer, who covers Uber. So, Eric, what do we need to know about Careem?
You know, this is a moment where Uber might actually acquire territory internationally instead of retreating. So I think it's exciting for that reason that Uber here seems to be willing to pay a pretty big price tag, $3 billion. And, you know, this is not sort of a done deal by any means, but it looks likely that at $3 billion, you know, Uber could acquire Careem's business there and there would be some sort of combined forces in the Middle East.
What is Uber's position in the Middle East right now?
You know, they've been competing back and forth aggressively. So I think, you know, two strong players there potentially coming together. And so, you know, like in a lot of markets, Uber's sort of positioned itself as bringing the technology and efficiency to bear while competing against local players that have that sort of local knowledge and sort of hometown sort of advantage.
Bigger picture, give us an update on how Uber is doing internationally, about retreating from China, retreating from Russia, retreating from Southeast Asia, you know, and also in the context of the fact that Lyft really doesn't have much international business at all.
Right. You know, Lyft's business has been focused mostly only on the United States with a slight presence in Canada. Uber has been all over the world. I think Latin America is certainly an important market, Europe, you know, and then they're trying all sorts of tactics to get into places like Japan that have been holdouts. So it's still very much a global business, and the Middle East is a key part of that. And I think we're going to see a lot more, and I'm excited to see a lot more when they file their S1, you know, in a couple months. And so I think that will tell us more about sort of how competition globally is affecting their business. But Uber definitely still has a pretty big global footprint. And then also don't forget that they have stakes in those companies that they left behind. You know, whether it's Grab or Didi, Uber still has an equity stake in those companies, so has some upside if those companies continue to do well.
Could a big deal like this impact the timeline to IPO?
You know, they've been working on this for a while, so I think it's certainly been on their mind. It's not a surprise. This has been a deal we've reported on and have been watching for quite some time. So, you know, they probably need a little lead time to update things, but I don't think it really changes the game. All we've really been saying is that Uber's hoping to go sometime this year, probably the first half, and I think, you know, I don't think this will affect that dramatically.
All right, Bloomberg's Eric Newcomer for us in New York. Eric, thanks so much.
Thank you.
For that scoop. Coming up, Tesla is putting a $35,000 version of the Model 3 on the market. What does it mean for the company and the future of electric cars? We'll discuss next. Also coming up, Benchmark's Bill Gurley backing an app for gig workers in the hospitality business. Can Instawork grow from its early successes? This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Emily Chang in San Francisco with Heidi Stroud-Watts in Sydney and Sherry An in Hong Kong. Let's get a look at the global tech stories of the day. Heidi, what are you following?
Emily, SoftBank's Vision Fund is betting big on the Chinese car market, specifically used cars. The fund is investing $1.5 billion in Chinese car trading platform Chehaoduo Group. This means that Chehaoduo has a valuation of more than $9 billion as it competes with the likes of Yuxin and Suche in a segment that has remained largely resistant to disruption. French telecom giant Orange is asking Huawei to accept France's terms to supply 5G technology. Those terms include full access to equipment used in core networks and antennas, including motherboards, encryption keys and code. The request comes as the EU tries to determine the risk of using Huawei's tech in 5G networks. And a group of IT consulting firms is fighting the Trump administration's plans to increase limitations on the H-1B visas. The alliance has filed over 40 lawsuits against US Citizenship and Immigration Services over visa denials. Since 2017, IT consultants are seeing a much higher denial rate of as high as 40% compared to just 1% for big tech companies like Google and Microsoft. Those are the top global tech stories that we're watching today. Emily.
Thank you, Heidi. We continue now with our coverage of Tesla. Tesla finally putting a $35,000 version of the Model 3 sedan on the market, almost 3 years after CEO Elon Musk started taking orders for it. David Whiston, Morningstar analyst who covers Tesla, joins us now on the phone. He's got a sell rating on the stock. So, David, obviously a big milestone to get to this $35,000 number, but with all the add-ons, you're looking at upwards of $60,000, not unusual as with any car maker. But how much new demand do you think this will drive?
Well, as you noted, we've been waiting for this vehicle for a long time, so I think there are a lot of people that, in terms of incremental demand, they're already in line. Obviously, you've lost some people who have just gotten tired of waiting and have moved on. The incremental demand may come from more of this new distribution model they're talking about, where they're going to an all-online selling method. That's going to be very interesting to see if that succeeds or not. It's really easy for the consumer, but at the same time, we're talking about a vehicle here, not ordering a shirt from Amazon.
Online also means that there will be fewer people who will actually need to sell these cars. So does this mean that there will be more layoffs as well?
Yeah, I was wondering if that was included in the 7% headcount reduction he announced earlier or not. I mean, I suspect it's not, but I haven't heard from the company to confirm that. But I would imagine, yes, that a lot of people at the stores are going to lose their jobs. But the trade-off is lower prices.
Sure. Will that drive demand was Emily's question as well, right? But should we be worried also about lawsuits potentially in those states that won't allow sales without a dealer franchise?
Yeah, that's a great point. That's been an issue that's been going on for a long time now with Tesla and the rest of the industry, and the dealer trade group, NADA, is a very powerful organization, well connected in Washington. And dealers are not opposed to Tesla. They just want to have Tesla franchises, too. They want to get in on the action, is my take on that. And it varies state by state. Some states are extremely restrictive, in particular a state like Texas, which is one of the largest car markets in the country. However, Tesla's still been able to get their vehicles into the hands of consumers in those states. Basically, you go into what's known as a gallery store. You can't actually buy the car at the store. You end up technically buying the store from a Tesla store in another state, and then someone delivers the vehicle to you in Texas.
Tesla does have 35 brick-and-mortar stores in California alone, and they did mention 7% of the workforce would be laid off in January. So you wonder how this new process will impact the workforce. David, what are some of the challenges you foresee with this online-only model?
The big one, I think, would be we'll get past any legal issues. I'm not a lawyer, so I'm not going to go too into that, but I'm not too worried about that. Just as we were just discussing, Tesla's been operating for a number of years already, and it hasn't slowed them down a ton. I think the next big thing is, will consumers be willing to buy the vehicle on their phone or laptop or whatever it may be in great volumes, because what they're doing, this strategy, it works very well when the customer knows for sure that they want a Tesla, and then they can go online and configure whatever Tesla they want. Just like if you want to buy a Porsche 911 or a high-end Corvette, it would be nice to just go to, say, Chevrolet.com, configure your car, and have it delivered to you without ever leaving your house. Tesla wants to go that route, and Tesla's not held back like the other OEMs are, because Tesla doesn't have franchise dealers. They own all their stores right now. But there are people that want to compare maybe a Tesla Model 3 to an Audi A3, A4, or BMW 3 Series, Mercedes C-Class, whatever it may be. And those customers, they may not be willing to go ahead and do the Tesla purchase without first driving the car. And that's why this very generous 7-day, 1,000-mile policy where you can still get a refund on a Tesla is a really interesting move, and potentially a very smart move. But will it be enough to get hundreds of thousands and ultimately millions of people a year to buy vehicles? Because remember, the German 3, they each sell roughly 2 million or 2 million plus a year, depending on which company you're talking about. Tesla's still got a long ways to go there, and it just remains to be seen if they can do it. But making the experience easier at retail is a smart move.
It's hard to imagine anyone making a purchase as big as a car, a Tesla, without test driving it first. But that said, Musk, speaking at this news conference, saying that producing the car at this $35,000 price, again, without any add-ons, he says it's excruciatingly difficult to make this car for $35,000 and still be financially sustainable. David, what are the economics here? How much more pressure is this price going to put on Tesla's bottom line?
Well, at the same time, you'll have a lot of costs going out, and the theory is eventually you make it up in volume. And I think ultimately it's hard to say exactly how many consumers, but certain consumers that want that $35,000 car, they're going to want some other features, and all of a sudden they're spending 42 or 46 grand or whatever it may be, all the way up to over 60 grand, as you noted. You need to have other vehicles, though, too. That's why the Model Y crossover on the 3 platform coming is helpful down the road, and ultimately a pickup truck, too. That's a huge segment.
David, we're now getting news from NASDAQ saying that the Tesla stock will resume trading at 5:40 p.m. Eastern. That would be in less than 5 minutes from now. We saw the stock drop as soon as the announcement was made, and then it was halted, although throughout the day it actually rose. So what are we expecting this announcement to do for share prices?
I'd be surprised if we had a rapid spike here, because the $35,000 Model 3, that's not new information that we've been waiting a number of years for. It was just a matter of when. And there were earlier comments from Elon that it would probably happen at some point in 19. I think there's also that old cliche, buy the rumor, sell the news, too. And so I wouldn't be surprised if we saw a decline on this, because now that we know, there's no reason to get hyped up about whatever the announcement's going to be, because you know what the announcement is.
Some important color here, David. Pun completely intended. The $35,000 Model 3 is only going to come in black. Any additional color will be at least $1,500. Our Detroit bureau chief, David Welch, has some funny commentary saying that Musk is channeling his inner Henry Ford, who famously said once, any customer can have a car painted any color that he wants, so long as it is black. How much do these details matter?
David's absolutely right to point that out. I was thinking the exact same thing before you mentioned it on the air. That's the old Henry Ford quote. I mean, that's another example of, well, if you want a different color, fine, but you have to give us more money. So for years, I've never anchored too much on that $35,000 price tag, because it just doesn't work that way. It's not that simple. I mean, the range of a vehicle can range from at starting price, a car might be 28 grand, but fully loaded, it'll be 55 grand. It's just such a wide range. It really just depends on each individual's consumer preferences. But, I mean, to your question, as long as you want it in black, and there's a lot of people waiting for this car, and frankly, the Model 3 is a great-looking car, too. So it should do well.
David, thank you so much for joining us. David Weston, Morningstar analyst, joining us there on the phone. And terminal users continue following the news and analysis on the Bloomberg T-Live Go. That is TLIV Go. Much more ahead, so stick with us. This is Bloomberg.
A new startup is making waves in the gig economy, gaining one high-profile VC's attention. Instawork just closed a funding round led by Benchmark. Bill Gurley is joining the board. The company connects workers with employees in the hospitality industry. So, does the gig economy have more legs? Sumir Magani, Instawork co-founder and CEO, joins me now here in the studio. So, what kind of jobs are we talking about here? What kind of gigs?
Well, really any position that is suitable for the hospitality industry. So restaurants, catering companies, event venues, cafes, so dishwashers up to cooks, servers, a pretty wide variety, but we have about 10 positions that we focus on.
How do restaurants and hotels deal with hiring for these positions right now?
It's a wide variety of ways, but the most notable is a sign on the window. They leverage their networks, their mobile phones, maybe job boards, and one of the things that's been exciting for us is really servicing a set of businesses who really don't have any good options today. They don't have LinkedIn, they don't have recruiters, they're really winging it, and we think Instawork can be a really valuable tool for them.
Now, Bill Gurley, of course, famously invested in Uber, and the success of Uber led to a raft of Uber for this, Uber for that startups. What makes you think this is a gig economy opportunity that won't be a flash in the pan?
It's a really good question, Emily. One of the most amazing things the last year that we've discovered is there's a large pool of workers who want to be a part of the gig economy, but the existing sort of alternatives have let them down. They're immigrants, they're college students, they don't have a nice car. but they have free time, they've got a skill, they've got a desire for economic opportunity and freedom and flexibility, but they're not driving for Uber or Lyft or a number of companies. And we found a way to help them monetize their time with their skills and help them grow and develop by using our app.
There's an increasing amount of scrutiny on the benefits or lack thereof for contract workers. How do you handle that? I mean, do you provide any of those benefits? Do you help them with those benefits?
It's a really good question. So we, all of our professionals are 1099 contractors, but if they don't have their existing insurance, we help them get the equivalent of workers' compensation as contractors. So if they get injured on the job, they're able to participate. And we also provide best-in-breed earnings. You know, our workers make about $140 on average for a gig. We think that's at the high end of all the alternatives that are available, about 150% of minimum wage. So workers get paid, very well, and what they see in the app when they accept a gig is what they make. So we're not playing any games with smoke and mirrors, like I think we've heard recently of a lot of companies in this space. So what they're seeing is their true earnings upfront when they accept the gig, and it's really good income.
So what is the competition out there?
Well, as I said before, I mean, the biggest competition is a sign on the window or doing nothing at all. If you talk to a restaurant owner here in San Francisco and a dishwasher doesn't show up, most of the time they're managing without that dishwasher. And
is this something that TaskRabbit would do, or, I don't know, Thumbtack, Handy?
I think there's a lot of places that people could go, but they're actually coming to Instawork more and more. And one of the main reasons is quality, speed, and convenience. That's our value proposition. And so we vet our professionals in the mobile app. We're able to fill 97% of our gigs within 24 hours. And businesses are able to pay professionals through our app in a very convenient way. And so we manage a lot of the workflow and a lot of the matching, which makes it sort of, one-click stop for qualified help.
How big do you think this market can be? Obviously, Uber is potentially a $70 billion company. TaskRabbit ended up being something much, much smaller. Both very different companies. But how big do you think the market is here?
We think it's really big. And just to put in perspective, in the US, there's probably about 1 million businesses in hospitality, and those businesses employ about 15 million people. That's just in the US, so it's quite big. One of the most exciting things about Instawork has been if we're able to deliver quality professionals to small businesses at scale very easily, we can actually help set them up for success in a world with Uber Eats and Postmates and DoorDash. These services didn't exist many years ago. Those services have solved the top of the funnel. If you're a restaurant, you can now latch on to a lot of these services and get customers in the door. But one of the reasons we started Instawork was there's no efficient infrastructure to service all these customers coming in. And so we think that there's an opportunity to actually make the market bigger by providing quality labor at the touch of a button.
Would this ever involve, helping Uber find drivers, or, some of these other big gig economy services find the workers that keep them running?
Over the 4 years we've had the company, we've always sort of followed our users. They've taken us in different directions, and I think we'll continue to find ways, to add value for them. Just listening really closely to our professionals and partners.
Okay, Sumeer Maghani, Instawork co-founder and CEO, thank you so much for stopping by. We're continuing to follow breaking news out of this Tesla news conference. Elon Musk saying he does not expect Tesla to be profitable in the first quarter. Of course, we've been talking about the economics of offering a $35,000 car more with the add-ons and what that means for the bottom line. But news there that Elon Musk does not expect the company to be profitable in the first quarter of this year. More to come. This is Bloomberg. YouTube announced Thursday that it's banning comments on some videos with minors. In a blog post, the company said that it disabled comments from tens of millions of videos that could be subject to predatory behavior and will continue to do so in coming months. This after several large companies, including AT&T, Disney, and Kellogg, pulled their spending from the platform amid reports of predator activity in the comments section. Joining us to discuss, Bloomberg's Alistair Barr. So how exactly are these changes, Alistair, going to work?
So they're going to use a type of AI software, machine learning software, that is going to scan each video, and it's going to see whether the video features a child that is 13 and under, if it decides there's a child that is 13 and under in that video, it'll get rid of the comments section. So this nefarious activity will not be allowed to take place.
Now, we've talked a lot about how AI still has a lot of work to do and a lot of improvements to make. How is AI going to be able to tell for sure whether someone's under 13 or not?
Yeah, I wouldn't be able to tell whether someone's under 13 or not in a video anyway, so that's going to be very, very challenging. I think YouTube is basically making the decision that it's going to probably err on the side of getting rid of, like if there's a video of someone who's 14 but they're not quite sure, at this point they'll probably get rid of the comments section in that video as well, because right now they're on the defensive basically.
YouTube did release a statement on this today saying no form of content that endangers minors is acceptable on YouTube, which is why we've terminated certain channels that attempt to endanger children in any way. And this is on the back of a horrifying story where there was commentary beneath some videos that led to some sort of pedophilia ring. So the impetus was quite extreme. And getting rid of comments for YouTube is kind of a big deal because it's a huge part of the social aspect of the platform. How does this fit into the bigger picture of everything that YouTube is trying to deal with?
So from the point of view of comments and social, really YouTube isn't actually much of a social media entity unless you have the comments section. So if you're
and yet they've held on to comments forever, despite the fact that they're often very toxic.
Yep, and they've resisted getting rid of comments in the past as well. So if you're a video creator and you're doing a valid job, right, you're not being nasty on there. Comments are great because you find new viewers there, you get feedback from viewers. It's very valuable for creators, and YouTube has to balance. It needs all these creators to create content for YouTube, basically. So it is a very big deal that they're getting rid of some of the comments, at least.
Is YouTube leading here, or are they just playing catch up?
As usual, they're playing catch up because 3 years ago, or even maybe more, they were having similar types of problems, and they always say they're going to fix it. I think the main problem comes down to the fact that it's an internet platform and it doesn't want to be responsible for the content because it's impossible for it to check every piece of content properly. Even if this AI software actually does work a little bit, they don't want to be responsible for it. They want the people who post the content to be responsible for it. That's the key difference in what it means to be an internet platform. Anytime where they're forced to become responsible, they don't like it at all.
Well, here they are taking some responsibility. Bloomberg's Alistair Barr, thanks so much for that update. All right, new story just out. HBO CEO Richard Plepler is stepping down after nearly 3 decades at the cable network. Plepler made the announcement to HBO staff in a memo saying, quote, "Hard as it is to think about leaving the company I love and the people I love in it, it is the right time for me to do so." For more, I want to turn to Bloomberg's Lucas Shaw in Los Angeles. Obviously, this is big news and interesting in the context of the acquisition. What's happening behind the scenes here, Lucas?
Well, just this week, AT&T, which is acquiring or has now acquired Time Warner, got kind of the final sign that the DOJ's case to block the merger wasn't going to succeed. And once they knew that their deal was done, they could start making changes at the different TV networks that they planned. And Turner in particular, which has TNT and TBS, was one area where AT&T had been very hands-off. And we're starting to see the shakeup from that. Richard Plepler is leaving. There's a report out there that David Levy, who is the #2 executive at Turner, is also leaving. The previous head of Turner, John Martin, has already left. And so we're seeing what this reorganization of Warner Media, what used to be Time Warner, is going to look like now that it's owned by a phone company. I got off the phone with some people who work closely with Richard Plepler, who is one of the biggest executives in TV, and the sense was that he felt like it was the right time now that he wasn't going to have quite as much autonomy, and there was going to be a reorganization that might put him under a couple of extra layers. He's used to running this network with almost complete autonomy.
That said, this is fairly abrupt, and if you look at his legacy and what HBO has accomplished in the last 3 decades, it's pretty incredible. However, there is more competition today than ever before. Do you think AT&T executives were not happy with HBO's and his most recent performance?
I don't think they were unhappy with the performance of HBO. I mean, to your point, I mean, Plepler is this titan of the TV industry. He's been at the network for the past 25 some years. He's seen it grow from a company with a few million subscribers into one of the biggest TV networks in the world. It's immensely profitable. He was there and running the network when they greenlit Game of Thrones, which is by most accounts the biggest show in the world. But I do think that AT&T executives have signaled they want to kind of better integrate some of the different divisions of Warner Media, whether it's distribution, advertising, finance, legal. They see opportunities to save money and also to just run things a little bit differently. There have been reports that there's going to be a kind of a networks group at Warner Media, so maybe HBO will sit alongside TNT and TBS and maybe even CNN in one group, and then there would be more of a studio group that would combine Warner Brothers, the studio out here in Los Angeles, with some of the production that happens for the New York networks. And whenever you talk about a big reorganization, the people who've run those businesses are probably not going to be happy that some new owner is telling them that there's a better way to do what they've been doing, especially when you're somebody like Richard Plepler, who probably feels like he's done a great job the past several years, and there's nobody who can do a better job than him.
Well, perhaps it's poetic as we prepare for the last season of Game of Thrones. We're going to continue to follow this story. Lucas Shaw, thank you for giving us some additional context there for us from LA. That does it for this edition of Bloomberg Technology. We're live streaming on Twitter as always. You can check us out there at Technology. This is Bloomberg.